Most people don't realize how much of their personal information is being bought and sold every day. Data brokers are making millions pulling details about you from public records and the internet, then packaging and selling it, usually without your consent. That's how your information lands in the hands of scammers, spammers, even stalkers. It's why you get endless robocalls and why ads seem to follow you everywhere. That's where Aura comes in. Aura actively removes your data from broker sites and keeps it off. They also instantly alert you if your information shows up in a breach or on the dark web. But Aura goes beyond data protection. With one app, you get a VPN, antivirus, password manager, spam call protection, dark web monitoring, and even up to $5 million in identity theft insurance, all backed by 24/7 US-based fraud support. Other companies might just sell credit monitoring or just a VPN. Aura gives you all of it, together at the same price competitors charge for just one service. Start your free trial today at aura.com/hidden. Protect yourself now at aura.com/hidden.
This episode is brought to you by Progressive Insurance. Do you ever find yourself playing the budgeting game? Well, with the Name Your Price tool from Progressive, you can find options that fit your budget and potentially lower your bills. Try it at Progressive.com. Progressive Casualty Insurance Company and Affiliates. Price and coverage match limited by state law. Not available in all states.
Well, hello again. This is Mark from the Swamp School, and I want to welcome you to our podcast. In this episode, we're going to be going over what is all this stuff about mitigation banking, and what is all that about? How does that work? We've gotten a lot of questions over the years, and we have been in the throes of actually preparing a full-blown class on how to prepare a wetland mitigation bank and all the details. But we thought we'd give you a quick overview of what exactly a mitigation bank is and what you can expect basically you have to do to basically create one. So first and foremost, mitigation bank is, and we're going to be talking about what we're going to call an entrepreneurial bank. There are many different types of banks, and I guess we could kind of preface this by, the idea of in lieu fees and different types of banks. But to simplify it for this conversation, we're going to go after just the entrepreneurial bank, which is a bank that is being built with the hope that somebody will need the credits and that they will buy them. So the way that works is the banker is usually what they call the proponent of the project, is usually a group of individuals that will be a mixture of financial type people who basically have money to pay for all of this, as well as engineers, architects, maybe landscape architects, environmental scientists, surveyors, engineers, right? The other groups, you might throw in some drafts people and things like that. But basically, depending upon how you put together your team, you're going to have that on what we're going to call the proponent side. Now, what's weird about a bank is that you don't actually do this by yourself in a sense. The government, these are the scariest words you'll ever hear, is here to help. And the idea basically is that there's also what they call interagency review team, IRT. And the purpose of that is to kind of help you, and I'll use that in quotes, help you with your mitigation design. And truly they are trying to do that. And these are going to be the people from the Army Corps of Engineers, who's usually the chair of the team, as well as Fish and Wildlife Service, EPA, National Marine Fisheries, and then you might also have Native American communities involved in there. You may have some public interest groups in there, some nonprofits, things like that. Basically people that are interested in the area that you're working in that may have basically what we'll call stakeholder, they have a stake in the game here. So that's going to be your team. Now, before you do this, we're going to start out with what's called a prospectus. And a prospectus is essentially a business plan. And the idea is that you're going to identify an area that you want to build your bank in, and the Army Corps of Engineers, the EPA, and the IRT basically want you to do it based upon a watershed approach. So you're going to be looking at the bank location, and then what we're going to call the service area is going to be limited to the watershed the bank is in. And the extent of that watershed varies based on the IRT. It could be based upon hydrologic unit codes, which could be as fine as a 14-digit code all the way probably up to maybe an 8 or 6 code. Now, the bigger the number, the more digits, the smaller the area. So the smaller the number, the bigger the area. So you may have, entire basin, as opposed to just a little watershed or a catchment. So that's going to be something you're going to negotiate with the IRT. But in your prospectus, because you haven't met with the IRT yet, you're going to be preparing this business plan. And the idea is that with this business plan, again, we'll call it a prospectus. It's called a mitigation banking prospectus. You're going to identify a couple things. One is, again, the service area, which we just discussed. And you're going to propose the service area. And obviously, if you're a banker, you're going to propose the biggest area you can. So you're going to be going for the 6 or 8 digit HUNC, hydraulic unit code. And then what you're going to be doing is then saying, okay, your bank is expected to produce X number of credits. Now, credits are based upon mitigation type. And this is probably a longer discussion, which we'll have to go into. But basically, we have restoration, creation, enhancement, and preservation. And for right now, we'll just agree that those are different types of mitigation, and they each have their own credit values. Restoration usually being the highest, and preservation being the lowest in terms of value, which is ironic, actually. But the idea basically is that you're going to be creating this bank, and you're going to be generating X number of credits, and those credits are going to be negotiated in terms of how many do you think you can get with the IRT. So as your prospectus goes, you're going to propose that, and then you also have to provide the financial background to show that you're actually able to accomplish what you propose. And this is important because there may be bonds involved, there may be construction performance agreements and so forth, and there's also payment. The good news is that once you have your mitigation banking instrument, which is the next step after you finish the prospectus and after the IRT agrees with your perspective, you can actually start selling credits ahead of construction. You have a limited amount of time, I believe it's less than 1 year, before you have to actually produce a product, but you can actually sell it ahead of construction. The idea is it's to pre-fund some of your costs that may have gone into the development of the instrument. Now, the instrument is the next step. And again, I'm just giving you a high-level view. So we're going to go from prospectus, which is basically kind of like a preliminary plan, if you will, to a banking instrument, which would actually culminate ultimately with construction documents. So we're going to go from preliminary design essentially to a final design to ultimately CDs or construction documents. And that's what the IRT will be approving along the way. Presumably, this should be done within a year or so, so hopefully. And a lot of the things that motivate it are based upon the need for the area. So a lot of times you'll build a bank based upon a perceived real estate need where there's a lot of development going on in an area, and they need to build banks because in order to get the permits to fill in the wetlands associated with maybe road construction or things that are unavoidable, that they need to have the bank in place or they can't get the permits. So there's a direct correlation between the need for a bank and the development need in the community. So there's basically two factors there. One is, making sure that there's a need. You could have a beautiful bank in the middle of, somewhere in the Midwest that, somewhere in Iowa where there hasn't been development in years other than just growing corn. And there's, it would be a great place for a bank, but there's no need. So you'll get approved to build the bank, but you won't have anyone to sell to. And that's a big part of the prospectus, because what you're also going to be highlighting in your prospectus is essentially who are your customers? Who do you expect to have? What's the development pressure? And what is the anticipated need? And again, the idea with a bank is that it's kind of a last resort. The idea with doing a development in the permit process for just a commercial development, residential development type thing, non-mitigation related, you're supposed to, avoid to the maximum extent possible any wetland impact. So you avoid, and then if you can't avoid, you reduce your impact. So what we call avoidance reduction, and then minimize that impact as much as possible. And then as a absolute last resort is going to be the concept of mitigation. The presumption being that a mitigated wetland is not as good as the wetland that was being impacted. No matter how hard you try and how much work you put into it, the mitigated wetland is got years to go to grow into, the wetland that you're now impacting as a result of development. So that's just to be discouraged. So the idea with it is that with a mitigated wetland, you don't want to go in as a developer and say, okay, well, I've got to put, I got this 1,000, house lot subdivision I want to put in, and I'm going to wake about 10 acres, but not a problem because I'm willing to pay for, X number of dollars to a mitigation banker to build a bank or pay for the bank that's in place now. And that will give me my permit. And the Corps will resoundingly reject that because they've not gone through the avoidance minimization process, which is to avoid the wetlands in the first place. And do you really need 1,000, homes? Maybe you can live with, 800, and knock out 200 of them. And of course, they'll cry and scream about, how much that's going to cost them. So one of the things that's interesting about the bank is that if the IRT is doing its job, they want to make it fairly expensive. You should be wanting to make a lot of money doing a mitigation bank because you want it painful. The idea is that it should be the value of the credits should exceed the land value that the developer is working on. So because it's meant to be that way. So if you have a piece of property that's, let's say, worth $100,000 an acre to build on, and it's a swamp now, so it's not worth anything. So if I were to mitigate and I were to buy, let's say, we're going to build, and we'll just make up a number here. We're going to impact 5 acres of wetlands. So that's worth $500,000, let's just say. So I would have to pay the mitigation banking company, a dollar amount for those 5 acres. Well, usually there's like a 2-to-1 ratio. So you'll need 10 units to mitigate that 5 acres. Well, those 10 units should be at least $500,000, if not $1 million. And the idea is that you want it painful. You want it to be expensive to fill in a wetland. And the mitigation should not basically facilitate the filling in of wetlands. So you don't want to be a situation, well, if I take a $500,000, basically a useless piece of property right now, and I'm not really meaning to say wetlands are useless, but a useless piece of property right now, and I turn it into a bank, I turn it into a development, then, I'm taking something that's basically, let's say, $10,000 an acre is now worth $100,000 an acre, and it only costs me $50,000 to mitigate it. Well, I'm to the good about $40,000. So I've made money on that. So I want to fill in every wetland I possibly can. So to discourage that, the IRTs will make the bankers raise their prices so that it becomes more expensive to mitigate than basically the value of the land that they're going to develop. So basically to convert, I guess the way to think it, from wetland to upland. So it is meant to be painful. And so this is one of the reasons why mitigation banking becomes so popular, because you can make a lot of money doing it because it's by design. It's meant to be painful and cost more money than the land that presumably they're impacting is worth and would be, even the realized worth. Now, of course, you take a $100,000 piece of land and you put, a house on it. Now you got a $400,000 piece of land. You get into that issue, it becomes very hard. And so in some cases, you get into issues where these numbers are so crazy that it is wildly expensive to do mitigation in an area, but then basically the alternatives don't impact the wetlands, which is supposed to be the mission here. So at any rate, didn't mean to dive into all the numbers there. We have a lot more to cover on this topic. There's more than I can cover in just about a 10 or 12-minute podcast. So wanted to just basically give you an introduction to that. We will be following up with some additional concepts related to this in future episodes. So with that, I wish you well, and I hope you have a great day, and we will see you in the swamp.
When your daughter's learning how to drive and says,
Papa, can I drive?
You say,
Híjole. Here we go.
But what you should say is something that helps protect your ride.
Like a good neighbor, State Farm is there.
And that's where State Farm comes in, to help you choose the coverage you need, so you can relax until you hear,
Can we pick up my boyfriend?
Wait, what?
like a good neighbor, State Farm is there. State Farm, Bloomington, Illinois.